Barry Bannister. He is Stifel's head of institutional equity strategy. It's good to have you here, Barry. We've been going back and forth with Washington, D.C. McConnell says he might be willing to put the protection or liability protection on the side if Democrats will put funding for state and local municipalities to the side and deal with it later. Nobody knows where it's going to head up. What's more important to you think for markets going forward out of Washington?
Well, clearly the Fed is standing aside, waiting for fiscal to do something. The Fed doesn't want to be the only responder to adversity. That would put them in a very bad position. They would lose a lot of independence. So the Fed is doing the right thing. They're just waiting for fiscal policy to come to a decision, and we'll see what they do. But this is the current political horse trading that's going on, and I don't believe it's anything new. We'll see how the negotiations go.
Barry, what does this mean for the markets, though, just in terms of some of the what investors have been looking for, what they have been hoping for over the last couple of months?
Well, there's an important concept here, and it's just the price, right? So if you were to compare all of the recessions since World War II, so there've been 12, and you took the S&P from the lowest month, the end of the recessions. This is the highest we've ever been in 75 years after the recession ended, assuming the recession ended in the May-June timeframe. It was about a 3-month recession, at least the first phase was. So we've had a great run. It's been policy assisted. A lot of it is monetary. Rate and yield suppression causes you to put a high multiple in the market, and that's where we stand right now. A very high PE market, trying to anticipate reflationary fiscal policy, not really getting it yet, and knowing that it's a fine balance. There's such a thing as too little and too much inflation, and we're on a knife edge.
Barry, I'm curious. A lot of us really just want to know one number, and that's usually what can we expect as far as a return, say, from the S&P 500. If you look 10 years out, I realize that it's a lot to ask anybody to try and make that prediction. But what do you think we're going to see?
Now, in an odd way, it's actually easier to forecast a 10-year forward return than it is to figure out what's going to happen in the short term, because one of the laws in finance, it's worked for 75 years in monthly data that we've looked at, is that something called the CAPE multiple, the PE on trailing 10-year inflation-adjusted earnings, so you normalize, smooth out the earnings cycle. The CAPE multiple is very high. That's always been a reliable predictor of forward 10-year returns being low. The same thing happens when you look at household ownership of stocks as a percent of household financial assets. That excludes real estate. When it's high, your forward 10-year return is low. And then the third one is on a market value to sales, market value to GDP, or a price to book, which is called Tobin's Q, price to replacement book. All the measures that we look at say that the next 10 years, the compound return, it's not linear, will be about 3% a year or so. And that's 2% from dividends, 1% from price. Now, you could go sky high in the next year, but then have a crash, and then you'd still be correct in terms of the 10-year outlook.
All right. Barry, we always appreciate your insight and for joining us here on Yahoo Finance. We wish you all the best.